Financial Accounting Chapter 11. Introduction. Assets are anything valuable that your company owns, whether equipment, land, buildings, or intellectual property. When you look at your assets, you're trying to answer a simple question. How much do I have? If it has value and you own it, it's an asset. Some common asset types include accounts receivable, any payments that your clients and customers owe you; cash, the money you have in your business bank account; inventory, any goods you have in stock that you intend to sell; property and equipment, any buildings or tools that you need to operate your business. What are liabilities? Your liabilities are any debts your company has, whether it's bank loans, mortgages, unpaid bills, IOUs, or any other sum of money that you owe someone else. When you look at your accounting software or spreadsheets and look at your liabilities, you're asking, what is equity? Once you've figured out how much you have and how much you owe, it's natural to ask one more question: how much is left over? That's what looking at your equity tells you. How much value is left over once you've totaled up everything valuable that you have and subtracted everything you owe to your creditors. For a small business owner, equity is the net worth of your business. Cash and receivables. The amount a company reports as cash in the current assets section on its balance sheet must pay current obligations. Cash receivables means in respect of any sale of shares constituting collateral by borrower, and solely during the period from the time of trade of such sale to the time of settlement of such sale, the aggregate sale price in dollars or Canadian dollars, as the case may be, of such sale, provided that such shares were or are required to be released from the collateral account following Section 2.10b or Section 2.10. Such shares were sold in a regular way. Transaction or transactions, and the sale proceeds on settlement of such sale will be remitted directly to the collateral account as cash collateral thereunder. Investments. An investment is an asset or item acquired to generate income or appreciation. Appreciation refers to an increase in an asset's value over time when individual purchases a good as an investment. The intent is not to consume the good, but rather to use it in the future to create wealth. An investment always concerns the outlay of some capital today, time, effort, money, or an asset, in hopes of a greater payoff in the future than what was originally put in. Liabilities. A liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Recorded on the right side of the balance sheet, liabilities include loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. Equity. There are two primary ways that equity is used in finance. The equity meaning in accounting refers to a company's book value, the difference between liabilities and assets on the balance sheet. This is also called the owner's equity, as it's the value that an owner of a business has left over after liabilities are deducted. The term equity can be used in several different ways, from home value to investments. For accounting purposes, the concept of equity involves an owner's stake in a company after deducting all liabilities. Here's a closer look at what counts as equity in accounting and how it's calculated. What is equity in accounting? In finance, there are two main ways that equity is used. In accounting, equity refers to a company's book value, which is the difference between its liabilities and assets on its balance sheet. This is also known as owner's equity, and it refers to the value that a firm owner has left over after liabilities have been subtracted. In accounting, the term equity can also refer to the market value of a company's stock. This is calculated using current share prices or a value set by the company's investors. It's commonly referred to as shareholders' equity or net worth in this context. If the company's assets are liquidated and its obligations are paid off, The shareholders' equity is the amount of money left over to distribute to the company's shareholders. Book value of equity in accounting. To calculate the book value of equity in accounting, you can use the following formula. Equity equals assets minus liabilities. Accountants use this equity value as the basis for preparing balance sheets and other financial statements. In this case, the asset value includes all current and non-current assets, such as cash, inventory, prepaid expenses, property, machinery and equipment, accounts receivable, intellectual property. Reserves and provisions. Provisions are any amount written off or retained by providing depreciation or diminution in the value of assets or providing any known liability of which the amount cannot be determined with substantial accuracy. Meaning of reserves: that portion of earnings, receipts, or another surplus of an enterprise, whether capital or revenue, appropriated by the management for general or a specific purpose other than a provision for depreciation or diminution in the value of assets or for a known liability. Comparisons of debt and equity. When financing a company, cost is the measurable expense of obtaining capital. With debt, this is the interest expense a company pays on its debt. With equity, the cost of capital refers to the claim on earnings provided to shareholders for their ownership stake in the business.